All right, welcome back to FX Street. I apologize for the confusion. It's 8:05 a.m. Eastern. This is Adam. I'm assuming that I'm on right now. Looks like we had two speakers trying to present at once. FX Street, please tell me if I should not be here. I assume it's supposed to be me. Although I'm certainly open to the idea of Ed and I presenting together. That would be a lot of fun. Anyway, okay, it's my turn. Okay, it's 8:06 a.m. Eastern. Sorry for the delay. September 27, 2012. My name is Adam Rosen. Very happy you could join us. Today. In 25 minutes. Put all this positive reinforcement. I love it. In 25 minutes, U.S. GDP will be released. It's a very big number. It's the first big number that we've seen since the September 13th Federal Reserve meeting. The chart that you should see right now, please let me know at any time if you can't see the charts, by the way. But the chart you should see is a dollar Swissy daily chart. The vertical line marks off September 13th. That's when the Federal Reserve last met. That was the infamous Federal Reserve meeting where we all expected quantitative easing 3 to be introduced. Quantitative easing 3 was in fact introduced. Now, from what we've learned, it's okay, Ed. I'm trying to talk them into having us both present at the same time. That would be a lot of fun. Okay, so September 13th was last Federal Reserve meeting. Quantitative easing 3 was in fact introduced. From what we've learned from QE1 and QE2, the dollar is supposed to weaken. Why is the dollar stronger now than it was in September 13th? In fact, if you had sold short the dollar Swissy as soon as QE3 was announced, you'd probably be losing a little bit of money. In fact, the closing price for the dollar Swissy on that day was 93.46. The dollar Swissy now is 93.92, so not 93.92, 93.46. So you actually would be up about 20 pips right now. Well, is that right? But at any rate, maybe that's not right. 93, yeah, okay. So, but nevertheless, you can see we're definitely not making a lot of money on our dollar Swissy shorts. And in fact, the dollar Swissy did start to round to the upside. It would have been a better situation to buy the dollar. Well, okay, now let me correct myself here for a second. September 13th was the meeting, but it was a September 13th and 14th, or was it 12th and 13th? At any rate, the dollar Swissy's gone up since then, since the Federal Reserve meeting, after the eventual spillover. My personal opinion, I think this is a case of buying the rumor, selling the news, or in this case, selling the rumor, buying the news. We know from quantitative easing 1 and quantitative easing 2, the dollar tends to go down because quantitative easing involves the printing of new money, injecting that into the economy to buy long-term treasury bonds, or in this case, mortgage-backed securities. Nevertheless, we tend to see more dollars. We see more dollars in circulation, and that dilutes every dollar that we have. So the dollar is supposed to go down. Well, the dollar went down in anticipation of QE3, but once QE3 was announced, or I like to call it QE3 light, the dollar's gone up. If you were to take a look at stock market, in this case, look at the Dow Jones Industrial Average. That's a lot of lines. Okay. September 13th is this jagged line over here. And we know from the past that in quantitative easing 1 and quantitative easing 2, the stock market tended to go up. Now, it's not a lot of time. We can't really, I don't know if we can necessarily judge QE3 based on only a week and a half's worth of trading activity, but nevertheless, we definitely do not see the market making new highs. In fact, the stock market is lower than it was. If you had bought the Dow Jones Industrial Average on the closing day, on the closing price of QE3, September 13th, 13,537, well, right now, 13,480 is where the futures are at, and clearly we can see a reversal. Same thing with gold as well. Gold tends to go up during quantitative easing, very simply because of the diluted dollar. During during those periods of time that the dollars that we have quantitative easing, the dollar is diluted, and to protect our assets against the diluting dollar, we buy gold and other commodities. If you had bought gold on that day, 1768 for an ounce of gold, right now 1757, you would have lost 3 different ways. Now, the question is, well, there's 2 questions. From number 1, what's different about quantitative easing 1 as opposed to, let's go back to the dollar, let's see, what's different from QE 1 and 2 than 3, and what do we expect from the future? Now, this all ties into the U.S. GDP number today because we know the Fed watches 3 big numbers, okay? The number 1 reason why currencies move is central bank decisions. That's the number 1 reason. Now, the central banks, in this case the Federal Reserve, watches 3 big numbers in their projections. So the Fed's projections, they address 3 big numbers. They talk about inflation, which in this case we talk about the PCE, personal consumption expenditure. We talk about growth, GDP, that's today, and we talk about employment, the monthly unemployment level, non-farm payroll report. The unemployment level is really the one we watch for the Fed. The Fed watches these numbers and they make projections. Where do we think the economy is going to be by the end of the year, by 2013, 2014? And based on the actual performance of the economy, the Fed will then make the decisions to they can't lower interest rates anymore, either to raise interest rates if things start to get really good, if conditions start to improve, or the Fed they can't lower interest rates, but they can inject more monetary stimulus, more quantitative easing. Now, the Fed had said, all right, and that's kind of confusing. The Fed had said, okay, we're introducing QE3, but like I said before, I think it's QE3 light because it's not as potent and it's not as big as QE2. By the way, what's the difference? QE2 versus QE3. Okay? QE2 they were buying, I believe it was $75 billion a month. QE3, they're buying $40 billion a month of what? Fixed income assets, securities. QE2, they were buying long-term treasury bonds. They buy the long-term bonds, the yields go down. It de-incentivizes us to keep our money in a savings account or to keep our money in any kind of bond. It creates more incentive to go out there and buy a house because long-term interest rates are low, to buy a car, any kind of big-ticket item that is interest rate sensitive, or to keep our money in the stock market, which is also interest rate sensitive, meaning stocks tend to go up when corporate earnings go up. Corporate earnings go up when corporations can borrow money for a lower interest rate. QE2, they bought long-term treasuries. QE3, they're not buying long-term treasuries. What they're buying is mortgage-backed securities. I think it's mortgage-backed securities. I think that's how they say it. Now, that's still good for the housing market. And in a sense, you think of all the homes in foreclosure right now, and all those banks that own all of those foreclosed homes, and banks, the last thing they want to do is own a house because they don't know how to deal with homes. They know how to deal with financial products. So the banks, they don't want to lend. What's one of the biggest problems in this country? The banks don't want to lend. We can't buy a house even if we were able to. Okay? Well, the Federal Reserve's thinking is this. Let us buy those mortgage-backed securities. Let the banks sell to us being the Federal Reserve, all those toxic loans, that toxic debt. If we can take that toxic debt away from the banks will now feel more comfortable to lend money. So that's what the Federal Reserve is doing. I see your comments. I'm not ignoring them. I'm just trying to tie them all together because they are great comments. The other difference between QE2, the Federal Reserve also said that Operation Twist will end at the end of this year. that was no surprise. They told us that in June, no difference. So that was already expected. That was already, as they say, baked into the cake. So the only thing that's really new is that they're now buying 40 billion versus 75 billion more of bonds, and they're not buying treasury bonds, they're buying mortgage-backed security bonds, which is great. I think if it's gonna, if you're investing in the housing market, that's good. But it's not so good. I think that if you have exposure outside the housing market. Now I know the rationale is the Federal Reserve is thinking, well, if we help the housing market, the banks will start to lend, people will start to buy homes, home values will go up, people will buy a house, then they're going to go to Home Depot, they're going to buy lots of new stuff to fix that house because a lot of the homes are in bad shape these days, and Home Depot's earnings are going to get better, and then everybody's going to start to make money, and overall the economy will improve. And I agree, I think that over the long term will take place. But I think that buying treasury bonds is a much more potent or aggressive way of, sort of manipulating the economy. Now, the comments, and look, I hate to talk about politics because, you're always going to offend somebody, but we have to take into consideration what's going to happen between now and November, the U.S. presidential elections. And the politics, they usually don't play a big role except for the fact that this particular election is very much centered around the number one topic, the economy. And one very large component of the economy is monetary policy. Specifically, well, of course, from the Federal Reserve. The Federal Reserve has a dual mandate. And I know we're supposed to talk about GDP, which I will, I promise. We have about 13 minutes to go here. But it's all related. Okay. So the Federal Reserve has a dual mandate. Feds, okay, dual mandate. They're mandated by Congress, price stability, and they are supposed to create an environment, I forget exactly the words that they use, environment that is conducive for job growth. They don't use that word, they should. Okay. So the Federal Reserve says, okay, if the economy's bad, we're going to lower interest rates. Now, we can't lower them too much because then that'll create inflation. That's when oil is $100, $150 for a barrel, $5 for a gallon of gasoline. Food at the supermarket is so expensive we can't afford anything. That's not good. That's too much inflation. That's when interest rates are too low, too long. Former Federal Reserve Chairman Alan Greenspan was blamed for the inflation that occurred in the housing market, in the housing bubble, as a result of Alan Greenspan keeping rates at 1% for 1 year. Think about it. Alan Greenspan, I think it was, 2003, he had 1% interest rates for, I always forget if it's 11 months or 13 months, or round it off to a year, 1 year. And that supposedly created a housing bubble. Now, I disagree. I think that there was, a lot of other hands at work. But if that is the case, what will 5 years, how long have we had zero interest rates in the U.S.? 2008, now 9, 10, 11, 12, 4 years. Federal Reserve is not projected at this point to raise interest rates until 2015. Let's cut the difference. Let's say 2013. That's 5 years, 6 years of 0% interest rates. If we had such a housing bubble because of 1% interest rates for 1 year, what is zero interest rates for 5 years plus QE1, QE2, QE3, Operation Twist, the tax credit for new home purchases, first-time home purchases. Remember, we had the cash for clunkers and a dozen other programs. What kind of housing bubble is that going to create? Well, okay. Now, the politics tie into this in the sense that, okay, if President Obama is reelected, then we don't know if we're going to get another term of the current Federal Reserve Chairman Ben Bernanke. He's supposed to. No, I'm sorry. I don't know that for sure. I stand corrected. I think that let me correct it. If Ben Bernanke, because he's become kind of political, if he doesn't continue, I think his policies will continue. What are his policies? And you're right. Really, nobody knows anything. I'm guessing. I'm guessing that Ben Bernanke probably is not going to have a job either way, just because politically maybe it's become too much of a hot button issue. But I think that if the current administration continues, I'm trying to word my words very carefully here. If the current administration continues, I think we'll see the current policies continue. Current policies, zero interest rates, and a lot of very aggressive monetary policy, in the sense that it's Keynesian economics taken out to the third standard deviation. Okay? Now, what is Keynesian economics? It means, John Maynard Keynes, he said that the economy is bad, we should lower interest rates to soften the blow. But we should lower interest rates a little. And when the economy is strong, we should raise interest rates to soften the blow, to smooth out the curves of the sharp edges of economic recession and economic peak. Okay? And we have GDP, by the way, coming up in about 8 minutes, so I don't want to get too off track. I already am. What we have now with the current administration is much, much more in the form of QE1, QE2, QE3, which as a result has weakened the dollar and created a very, very large commodity bubble, and gold, oil, and other precious metals and things like that. Okay. Getting back to the topic, though. U.S. GDP is going to be released in about 7.5 minutes from now. Let's take a look at another chart. The Federal Reserve, during their last meeting, updated their projections. I got really off topic there. We went from GDP to John Maynard Keynes. Okay, so it's all interesting stuff. The red line is the U.S. GDP that is projected right now to be released at what 1.7% is a consensus. Let me refresh a chart here. 1.7% consensus. Let me know if you can't see this, by the way. Okay? If the GDP, and that's the red line, by the way. The blue lines are the Federal Reserve projections. They were just updated September 13th. The Federal Reserve says, okay, we project now that GDP by the end of 2012, this year, should be between 1.7% to 2.0%, if I have my figures correct. GDP projections for 2012, and I'm going to give everyone the link. Do I have it right? Yeah, 1.7 to 2.0, 1.7, 2.0%. Those are the Federal Reserve projections. Today, GDP is projected at 1.7%. So, why is GDP important? Because what happens if GDP is released at 1.5% or worse? This is a link, by the way. This is the PDF document from the most recent Federal Reserve meeting, their projections. Okay? If GDP comes in worse than expectations or worse than projections, expectations are made by analysts, projections are made by the Federal Reserve. If it comes in worse than expected, we can expect more 0% interest rates, but that's not going to change anything because they're already pushing it to 2015. We can expect QE3 to continue. Now, it's very important. The Federal Reserve, during the last meeting, they said, okay, QE3, we're going to maintain QE3. They didn't say until the end of 2012. They didn't say until, 2013. They said until conditions get better, and they did not get any more specific than that. I would ask you the question, what's the purpose of having Federal Reserve projections if they project, if they say their policy is that we're not going to change our policy until, quote unquote, things get better. I mean, they use a little bit better language in that, but they did not use a hard date. Things have to get better. Now, what could the Federal Reserve do on top of QE3? They could revise up QE3. And if I remember my monetary policy correctly, QE1 and maybe even QE2, one or the other, maybe both, they were extended. We had QE2, and I think the Federal Reserve, correct me if I'm wrong, but they prolonged or they extended QE2. We had Operation Twist that was supposed to end in June. That was extended through the end of the year. We could very well see the Federal Reserve, again, if the current political administration in the White House continues, we could very well, and the current monetary policy continues, we could very well see the Federal Reserve will say, okay, we're going to have more QE3 and more QE3, and we're going to extend QE3, and we're going to have super QE3, and that could turn into QE4 and 5 and 6. Who knows if things don't get better? Going back, by the way, I didn't mean to ignore any of these questions. Alan Greenspan was not alone on the FOMC decision making, so he has to take responsibility for all. Yeah, I mean, that is the case. The tradition, from what I've heard, is that the other Federal Reserve officials will usually follow the president's lead. Who was it that actually dissented? He was a non-voting member of the Federal Reserve, so it really doesn't matter. I think his name's Plosser. So Charles Plosser is one of the Fed presidents, or one of the regional Federal Reserve officials, not the Fed presidents. But the tradition is they're all supposed to stand behind Ben Bernanke. That's why they're saying QE3 infinitive. But I would argue, great, okay, they're going to extend it perpetually, but that is not necessarily going to help the economy because they're extending its QE3 infinitive, true, but it's QE3 light infinitive. I don't know how much it's, I don't know, I'm trying hard not to interject my own opinion, but I don't know necessarily if this is, if this is the right direction. We have 0% interest rates. If someone out there that is able to buy a home is sitting on the sideline, I don't think that person is not buying a home because interest rates are too high, right? I don't think that the banks are not lending money because they're not confident of the economy. I think that the banks, look, the way the banks work is they're one great giant statistical model. And by the way, we have GDP coming up in a few minutes here, 1.5 minutes. The banks have this model that they use. The customer walks in the bank and says, I want to buy a house. This is the time. I have a good job. My credit score is great. Now's the time. I want to buy a house. And then the bank is going to make the decision, well, is this person really employed? How much money does this person have for down payment? Can we trust this individual to pay back the loan? And let us look at our model. How much money what's our track record been like, for these people with this kind of credit score, and what does our own balance sheet look like? Now, banks make no mistake. They make money when they loan, when they loan money. They loan money at one interest rate. They borrow money at another interest rate. It's the difference between a savings account and a 30-year mortgage, and that's how the banks make money. Now, you take Operation Twist into consideration, where the Federal Reserve is buying long-term treasury bonds or selling short-term treasury bonds. They're compressing the interest rate curve. They buy the long-term bonds, long-term interest rates go down. They're selling short-term interest rates go up. What's the difference between long-term interest rates and short-term interest rates? It's the same thing as saying what's the difference between the 30-year mortgage and the short-term savings account that we have in our bank account. By the way, we have GDP coming up very, very shortly here. Operation Twist is compressing that yield curve. Here's the FX Street calendar, by the way. So my point being is that I don't think it's just that alone. I'm seeing some kind of reaction here. I don't see the news yet. I'm sure I will in about 2 minutes here. Is it 1.3? I believe you, but I have to see this for myself. My solution, and it is a tough time for the Federal Reserve. If I was the Federal Reserve, there's not a lot I could do, because I don't think the solution so much is in monetary policy. I think the solution is in fiscal policy. We need less regulation and less taxes. I think that's the reason why businesses aren't growing. I'm waiting for the FX Street calendar. 1.3%. Is that unbelievable or what? Oh, I see here my Dow Jones news. And I believe you, by the way. I just like to see it for myself. Okay, so the durable goods. U.S. Second quarter final GDP 1.3% versus preliminary GDP estimate of 1.7%. Let's go back to our projections. That is bad news. Here's our projections. We were at, well, last month we were anywhere from 1.9 to 2.0%. We were expecting a lower GDP. Now, keep in mind, you know what analysts have been saying over the past, well, not all analysts. There was an analyst from one bank that said that, well, the iPhone 5 is going to be so successful that that is going to attribute for 0.5% of GDP. Do you believe that? They said the iPhone 5 is going to be, does that say that things are so good in the U.S.? Or it's so good in Apple, or things are so bad in the U.S.? How bad is the U.S. economy when Apple Computer can affect 0.5%? I don't think so. I don't think that they're going to sell so many iPhones that that's going to be the case. But the question is now, as we're watching the dollar, we're going to go to the dollar chart in a moment. Clearly, this is bad news. The question now that everybody's asking is, what is the Federal Reserve going to do? Are they more or less likely to raise interest rates in 2015 as they've now projected? I would say they're less likely, but probably, the percentages are probably going to go out a little bit further. We usually get right around the big numbers, the revised futures, the S&P futures on, what do they call them? The Fed funds, sorry, not the S&P, the Fed funds futures. That's a federal funds. That's a futures market that's trying to guess when the Federal Reserve is going to raise interest rates. And they give you a percentage. They'll say, before the number, we had a 50% chance the Federal Reserve is going to raise rates for 2015. Now that is a 40%. I don't know. It's on the Dow Jones news tape. I haven't seen it yet. They usually release that right after a big number. By the way, let me go back and read all the news here. Okay, so by the way, with Chicago Fed Midwest Manufacturing Index minus 1.2% on the month, 10.1% on the year. Let's go to the calendar, actually. It's probably a better, let me refresh the calendar here. Durable goods. Is that right? Minus 13.2%. I need to see confirmation. These numbers are so atrocious. I need to see confirmation. U.S. durable goods down 13.2% versus a consensus of a drop of 5.6%. But last month's durable goods, which were actually, if I remember, not that bad at all. They were up, I think, talk about a memory, I think they were 4.3%. Durable goods, by the way, released by the U.S. Census Bureau, this is from FX Street Calendar, measures the cost of orders received by manufacturers for durable goods, which means goods planned to last for 3 years or more, like a washing machine. That's what I remember from economics, is a washing machine. That's a durable good. For 3 years or more, such as motor vehicle and appliances. So I was right, washing machines count. As those durable products often involve large investments, they're sensitive to the U.S. economic situation. This brings up a good point, by the way. If we have 0% interest rates, if there's ever a time to buy a washing machine, now is the time. If we're going to buy that on our credit card or we're going to get a Sears credit account. The final figure shows the state of the U.S. production activity. Generally speaking, a higher reading is bullish for the U.S. dollar. That number was horrible. I know the GDP number was really, really bad. Durable goods was really, really bad. Question is, why is the euro dollar not going up? Let's go to the charts, by the way. The dollar Swissy is not really going down either. Go to a 5-minute chart of the dollar Swissy. We see initially, this is a 5-minute chart. Here's a reaction, but now the dollar Swissy is not really moving. We could also go to the euro dollar, same chart, which is basically showing nothing. Now, if it was only the euro dollar chart, if we were only looking at the euro dollar, I would say, well, maybe bad U.S. economic conditions. I love Rick Santelli. He's the best. If this was only the euro-dollar chart alone, I would say, well, maybe the bad economic conditions in the U.S. are, allude to the fact that, things are not going to get better in Europe either. That's the Forex trader in me thinking, well, if it's bad in one country, it might be bad in another. Maybe those who are watching the Federal Reserve are also watching the ECB, But the dollar Swiss is not moving either. I really don't know what the market's, the market's kind of perplexed right now because I know this, I'm guessing this because I'm perplexed. Because the question we have to answer to ourselves is this. The numbers are really bad, okay? Durable goods is horrible. The dollar's really bad. The durable goods number is bad, and so is the GDP. Why is the dollar not going down? Why is it not going up? The dollar, I would guess, would go down because this gives the Federal Reserve, this tells us, I think the dollar would go down because this says the U.S. economy is horrible. And the Federal Reserve is further away of raising interest rates. I think the dollar could go up because the number means that the economy is horrible. And this means we're going to get more stimulus and that's going to be good for the economy. Or I think the dollar is going to go down because the number is horrible and this means the Federal Reserve is going to inject more monetary policy. And that means not QE3 infinitive, super QE3 infinitive. They're not going to buy $40 billion worth of long-term mortgage-backed securities. They're going to add on another $40 billion a month of long-term treasury bonds to boots. And we're going to get QE5 and QE3, 6, and 7. And then I think this means that, and then I think that the dollar could go up because this economy is so bad that this means that the current administration is not going to get reelected and the other guy is going to get elected, and that means we're going to have a change. But then again, I think the dollar could go down because the new guy, the presidential candidate Romney is going to get elected, and then he's going to throw out Bernanke, and a new Federal Reserve chairman will be elected, and then we're going to get a whole different kind of monetary policy. And you could go on and on and on. My point being is nobody knows. I think this is very bad. I think that this is a sign. I think that stocks could go down, but as far as the dollar is concerned, who knows? I mean, the more I think about it, the more I tend to confuse myself. I think, someone asked about the CAD yen. I think that the yen crosses. Look, I'll answer your question this way. Let's go to a CAD yen. I think over the long term, and I'm looking at the CAD yen 5-minute chart, and I see that we saw an initial move down. We see now a reaction up. I think long term the yen crosses will go down because overall this is bad news. And if you look at the Forex market and you forget everything we know about the individual central banks and we just think about how the Forex market works, we have high interest rates and low interest rates. High interest rates, we take more risk. Low interest rates, we take less risk. Why? Because if you buy the Canadian dollar, where interest rates in Canada, I think 1% now, there is some chance that the Bank of Canada could lower interest rates. Okay? Especially the last couple numbers in Canada have not been so hot. But in Japan, they can't lower interest rates because they're already at zero. So you are taking a little bit more risk in Canada than you are in Japan. And you're taking a lot more risk in Australia and New Zealand than you are in Japan as well. So I think that bad news will send capital out of high-yielding currencies into low-yielding currencies and out of commodity-based currencies when we tend to buy more commodities, specifically oil, and the Canadian economy is very closely linked with oil. We tend to buy those commodities when the economy is stronger, because when the economy is stronger, we can afford to actually drive our car around and take airline flights and buy manufactured goods. I mean, people think that, oil is going to go up because of QE3, and I say that to be the case. But then you take a look at the durable goods orders. We're talking about big ticket items in the manufacturing sector. Think of those big ticket items. They are used, when they are produced, a lot of petroleum is used to create those items. How much petroleum, forget about the amount of gasoline we use to drive a car or oil we put in the engine. How much petroleum is used just in the production of an automobile, in the making of plastics? I remember learning at one point, don't ask me how or why, but I remember learning that a very large component of tires is made from petroleum. And if we're going to manufacture less cars, we're going to buy less tires and less tires will be produced. Goodyear Tires earnings move very closely with the price of oil, or at least are affected by it. So these are confusing times. Let me get to some of these comments while I have some time left here. Do you remember when the U.S. news is bad for the dollar, is bad, U.S. dollar will be strong, but of late, is it the opposite, how manipulators interpret the news, depending on the direction they want the market to go? Well, I don't know. I don't necessarily subscribe to the idea that there's any one individual or group of individuals out there that are manipulating a currency just simply because they're too big. You know, the obvious exception to that is the Swiss National Bank. When a currency is being manipulated, let's go to a chart here. When currency is being manipulated, you'll know about it because the chart's going to look like this. This is the Euro Swissy that went down, down, down because the Eurozone kept on losing steam and capital has moved out of the Euro into the Swissy, but Switzerland is an export-driven economy, so they can't handle a strong Swiss franc. So the Swiss National Bank said, you know what, enough is enough. We're establishing a floor at 1.20000. We're not letting the Euro Swissy go below 120. But, you know, the manipulators, this is a manipulator, Swiss National Bank, but they're not going to do it in secret because one of the reasons why this is so effective is because everybody knows about it. It's not like in the stock market, especially if you watch the old stock market movies, where you and I will get together and we'll pool together money and we'll buy a bunch of a very small stock and then we'll manipulate it up and then we'll put out a piece of news and then, you know, somebody else will buy and we'll sell and we'll make money. Well, first of all, there's a reason why manipulators manipulate very small stocks is because that's the only stocks they're able to manipulate. You can't manipulate General Motors stock. It's too big. If you can't manipulate General Motors stock, there's no way you can manipulate the U.S. dollar. Trillions and trillions of dollars. Somebody out there has $1 trillion. I'm sure they can figure out a better way to spend it, right? But to get back to your question, you know, the dollar will sometimes go up based on good news and sometimes it'll go down based on good. I mean, it really depends on the overall climate, what we're expecting. In this case, the number was much worse than expected. So now everyone is asking themselves a question. Number one, are we going to get downgraded? Is Standard & Poor's going to downgrade the U.S. credit rating again? Is the Federal Reserve going to initiate more quantitative easing? Super QE3 or QE4? Are they going to extend Operation Twist further along? It's supposed to end in December. What is the Federal Reserve going to do? So far, they haven't really given us any guidance. They just announced QE3, and look, lo and behold, the numbers have gotten significantly worse. So, to answer your question, we really don't know. The dollar, I would say this, if we expect, as a result of this news, the Federal Reserve sometimes will give us a little bit of a hint. If we expect that the Federal Reserve is going to get a lot more proactive, and they're going to say enough is enough, we really need to do something. I don't know. I'll take that back. I don't know necessarily. I mean, QE1 and QE2. QE2 is huge. I think that was probably the biggest ever. They haven't enacted Operation Twist since the 1960s. We're talking about 50 years of Federal Reserve policy. We have not seen Operation Twist, and it came back. I think the last time we had Operation Twist was when that song, The Twist, was on the radio 50 years ago. So I don't know necessarily, again, if it's you know, it's in the hands of the Federal Reserve. I mean, it's in the hands of, and I hate to say this, but it's in the hands of, you know, Congress and those, you know, look, I mean, we're getting into politics again, but ask yourself the question, what is it that's keeping the U.S. economy from growing? Is it too much regulation? I would say yes. I know in my own industry, in the financial industry, there's a lot more regulation than there was a couple of years ago. Is it tax policy too stringent? Is it too oppressive? Is it, you know, unfair? Again, it's political. You know, you say green, I say blue, and then there we go, we're going to get into a fight. So, you know, I think that's one of the reasons why the country is so deadlocked because, you know, nobody really knows what's going to fix. I think I really, really know. But then again, I think a lot of people really think they really, really know. And one of us has to be wrong. I hope it's not me. So I don't know as far as, what the market's expecting. I think that most likely, I'll say this, I don't know. I mean, if the Federal Reserve, I'm trying to answer your question, like what is the Federal Reserve going to do and what will happen with the dollar? I just don't know. I think that if the Federal Reserve gets even more aggressive, you could see a weaker dollar. But I think that the Federal Reserve has painted themselves into a corner. They've already diluted the dollar so much from QE1, QE2, Operation Twist, now Q3. And that diluted, I mean, it's not just words on the paper that, okay, our dollar's weaker, so what? That means I'm not going to take a vacation to Europe. Well, it's more than that. It means that that the dollar can buy less commodities. Food becomes more expensive, oil becomes more expensive. And for those individuals that import from other countries, those imports become more expensive. So a weak dollar, the U.S. economy was not built on a weak dollar policy. Japan likes a weak dollar because they're an export-driven economy. Switzerland is an export-driven economy. They export financial products, financial services. Think of those. Germany is an export-driven economy, and that's why the Europeans, if you feel bad for the Federal Reserve, you should really feel bad for the European Central Bank. How do you balance the needs of Germany, which is an export-driven economy, versus, I can't think of an example right now, but another economy that doesn't export so much, but more maybe Spain or Italy, that more, relies on the imports, or at least an influx of investment capital into Europe. And then how you balance those countries that use a euro currency versus those that do not. That's very, very tough. But the U.S. economy is a capital investment economy. We benefit when capital funds flow into the U.S. to buy U.S. stocks, U.S. housing, real estate, U.S. bonds, treasuries, etc. When that capital comes into the economy, those euros are converted into dollars, and the Aussies and the yen and the Swiss are converted into dollars, and the dollar goes up. So it's not necessarily that we want a strong dollar that'll be good for the U.S., but a strong U.S. dollar is a sign that the economy in the U.S. is good. It's more that the dollar follows the economy in the U.S., at least in my mind. I don't know if I got stuck in the Euro-Swissy charter. So far, very little reaction. I'm not surprised. Again, like I said, as far as the yen crosses, I'm assuming this is going to be a negative for the yen crosses because overall, I don't know if this is necessarily going to be the reaction right now, but I think that over the long term, we're going to say, this is not a time to take risk with higher yielding commodity-based currency. Now, I only have a few seconds here. Let's try to scan if we have any other questions. If I missed a question, by the way, please, let me know. By the way, in terms of the CAD, I don't know, was there any specific news about the CAD in Canada that I missed? US. I didn't see any Canadian news, but I'll say this. Canada is a very close trading partner for obvious reasons with the U.S. Let's look at the CAD Swiss. Is it the Swiss that's going up or the CAD that's going down, or is it a combination of both? I see the dollar CAD's going down a little and the CAD yen's going up a little, so it means the CAD's a little strong. Do I have a CAD Swiss chart? I have Aussie Swiss. Let's see here. So is the last one. Whoops. Right, well, doesn't matter. Okay, so CAD Swiss daily chart, long-term trend looks like it's to the downside, that's for sure. If the U.S. economy is bad, we're going to consume less oil from Canada, but Canada's a lot more than oil. I tend to think that the Canadian dollar is a proxy to the U.S. economy, in the sense that if the economy gets better here, we're going to see a stronger economy in Canada. So I think that the U.S. GDP number and the durable goods, especially the durable goods number, I don't think that that's going to be very good. I don't know why the CAD yen, or the CAD Swiss, sorry, is bouncing them temporarily. I think maybe it's a combination. I mean, it's a forex market. It's a combination of the CAD and the Swiss, and maybe, I would like to say, well, the dollar Swiss is doing this, but then again, the dollar Swiss is not really doing anything right now. I take this news into consideration in the overall picture. Is the U.S. economy improving? Obviously, it is not. We've made another leg down. Durable goods order was really, really bad too. And to talk about the U.S. dollar overall, I think that it depends on what the Federal Reserve is going to do, but I don't know necessarily. I think overall, I'll tell you this. I think that the dollar, I'm bullish on the dollar over the long term because we have 0% interest rates, and I think you're going to see a flight to safety. And I think that you're going to see capital continue to come out of those other currencies where we still can see interest rate reductions. That could be euro, it could be pound, and I think it could be especially the higher yielding currencies like Aussie, Kiwi, and to a lesser extent CAD as well. Overall, the daily chart, CAD, Swiss, we could even go to a weekly chart. We see a long-term trend, weekly chart to the upside, daily chart, we see the same kind of thing going on. The long-term trend is to the upside. We see by this chart that was eventually broken, but on a more immediate basis, the CAD Swiss is going down, I think. You draw the resistance as follows. Try to find a parallel support. That's not parallel. That's pretty close. Whoops. That's better. Perfect. Well, not perfect, pretty close. That's what I think about the CAD Swiss. I think it continues to go down. Look at the weekly, monthly chart. I don't really follow the dollar index. I usually use the dollar Swiss as a proxy. I don't even know if I have the dollar index on this charting pad here. But, in terms of the dollar Swiss, I'm bullish overall because I think that, again, you're going to see capital come out of other currencies. As far as the brokers, it's a hit and miss. I've had good experiences with some and bad experiences with the others. I tend to have accounts at a couple different places at the same time, so if I can't get a fill in one, I'll hopefully get a fill in the other. But overall, from my experience of trading stocks, when the news is released, it's really tough to get a good price. You kind of have to be in to win, But to recap, we have U.S. GDP, again, 1.3% versus the expectations of 1.7%, clearly showing a decline. Durable goods order, which is directly linked to the manufacturing sector of this economy. I mean, this is so complicated because you could ask yourselves the question, well, in the manufacturing states, how are they now most likely to vote in the next coming elections? Isn't Ohio a big manufacturing state? Well, durable goods affects Ohio to a large degree. How are those voters, and that's a swing state as well, how are those voters most likely to react at this point? It's a very, very difficult question to answer. But I think that if you take a look at the macroeconomic picture, you see obviously the U.S. economy is not improving. We've made another leg down. The trade might not necessarily be in the U.S. dollar, but if you take a look at, the other currencies that we can also draw a logical conclusion to, where will the yen crosses go? Where will the Aussie yen go? I think the answers become a lot easier. With that said, I'm out of time. If you have any questions, you can contact me directly, www.forexlaunch.com. I want to thank you all very, very much for joining us. Very special thanks to FX Street. Please see their calendar because we have a lot more ahead of us. Again, we thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon.